Duncan Goodwin, you are head of Global Resources Bearing Asset Management. You have a bit of a special investment approach. Can you explain this a bit detailed?
Yeah, we realise that there are very many alternative investment strategies in the resources sector, from a very commodity-driven approach to a very company-driven approach. We certainly focus our investment effort on the company-specific drivers. So we speak to management teams, we understand capital allocation, and we take a slightly longer-term time horizon for our investments. We are looking for a 5-year earnings growth trajectory and understanding how the market could be mispricing that longer-term growth. So the focus on companies is one differentiating factor. The second differentiating factor is we spend a lot of time looking at a wide variety of companies. So we specialize and focus on the commodity part of the resources sector, so iron ore companies, oil companies, petrochemical companies, but we also look at companies that are further down the value chain, closer to the customer, so companies that take commodities and produce products that consumers use, such as paint companies that take petrochemicals and provide paint, or refining companies that take crude oil and supply petrochemical or petroleum to the car industry. Our final group of companies we call next generation resources companies, and these are companies with emerging growth drivers in areas such as the electric vehicle, battery manufacturers, specialist material companies, health and wellness companies that are emerging trends and emerging growth trends in next generation of resources.
Before we have a look at your investments a bit more detailed, I want to ask you about the oil price. We observed recovery this year after the fall, but the last 7 days the oil prices fell again more than 6%. Was it just a short fall, or will this trend continue?
Yeah, it's clearly very difficult and not necessarily that rewarding to try and predict oil price trends on a 5 or 10 day basis. I think what we have observed is a classic cycle. We saw the crude market fundamentally oversupplied, being driven by increasing production coming from Saudi Arabia, Iraq and Iran emerging as a new supplier. That was coupled with significant investment in North American shale oil, which meant that the market was oversupplied, hence the drive from over $100 a barrel to under $30 a barrel. What happened then was the market simply reacted to that lower pricing. The North American rig count, drilling activity went from 2,000 rigs to 400, and we saw a significant reduction in capital spending in response to lower prices. That lower capital spending led to lower production, which means that the market is now coming more into balance, and when we include on top of that the speculative element, people speculating that the oil price would go higher, we saw a significant change both in terms of the fundamentals of supply and the speculative element that drove prices from 28 to 50. I think what we've seen more recently has been concerns around demand, whether that be through concerns about Brexit or China growth, and that's coupled with, clearly, if supply is falling heavily at $25 a barrel, at $50 a barrel we may start to see more investment come in. I think what's most interesting to us is, with the introduction of North American shale as a major supplier of crude, that means that the cycle is much shorter. In low oil prices, capex comes out very quickly in North America. With higher prices, as we're seeing now, we may start to see some capital come back into that industry. So I think it's a combination of short-term concerns around demand with longer-term higher prices could lead to more activity.
You already mentioned the Brexit, so you think Brexit fears are playing a big role in this oil price development?
I think in the short term we're seeing some of the speculative element come out based around concerns around demand for Brexit. What we focus on is much more structural fundamental drivers, we continue to believe that the oil price can go higher. We think that we are still very early in that supply reaction and the reduction in supply. And so beyond short-term concerns, both in the financial markets and concerns on demand, we still do believe that structurally higher oil prices are needed to generate sufficient cash flow to see capital come back into the industry and therefore bring new supply. So I think, yes, short-term, there have been some concerns. We think that really shouldn't, we think people shouldn't focus too much on that, but focus on the fundamentals where we're still constructive on the oil price from here.
You said the oil price can go higher. Right now we are around $50 per barrel. Can it go back to like $100 per barrel like it used to be in 2014, or you think it's not going that high?
Yeah, it's a good question. I guess the first honest answer is who knows. There are lots of elements driving the oil price. What we believe is that the energy cycle or the oil cycle has fundamentally changed. It's fundamentally changed because North American shale oil can come into the market very quickly in significant size with a marginal cost of, say, $50 to $60 a barrel. So if the oil price for whatever reason goes aggressively above, say, $60 a barrel, we think there is a natural balance where capital will come back into the North American shale market, and that will provide new supply. And let's not forget that one of the reasons why the oil price fell so aggressively is we were looking at a million barrels a day of new supply per annum coming into the North American market. So the crude is there, the crude can come. It's just a case at which that capital goes back. And I think that is a pretty meaningful check to a sustainable period of, say, $80, $90, $100 a barrel. But again, at 50, we still see there is a need for higher prices to generate the cash flow for that new supply to come in North America.
Earlier when we talked about your investment approach, you already mentioned the next generation resources. Can you explain what are these exactly?
Yeah, it's a relatively new area for investment for us. We recognize that the original attraction of the resources sector was the concept of the super cycle, and the super cycle in oil and iron ore and other physical commodities was not driven by supply cuts and lower production. It was driven by supernormal demand, driven by the Chinese, the Indian Industrial Revolution, and that the market did not fully understand the extent to which demand would outstrip supply, and therefore we got significant pricing for a number of commodities. And really what we're trying to achieve with investing in the next generation of resources is the same thing, to understand industries where there is going to become supernormal demand that is far in excess of the supply that is available, which will lead to significant pricing, significant growth in earnings that importantly is not fully yet understood by the market and therefore fully factored into valuation. So very simplistically, next generation resources for us is nothing more than trying to identify the next super cycles. And what is interesting is it isn't a reversion back to iron ore or crude. We've just talked about our skepticism that we can stay above $100 a barrel for any period of time. These tend to be more consumer-driven, behavioural-driven demand drivers. So factors such as electric vehicles and the battery manufacturing, the component supply into the electric vehicle industry, health and wellness. So changing diets, changing trends in food products, again, is an area where we see structural growth greater than expectation with an issue of supply as it takes time to catch up to that supernormal growth.
And can you also name the most interesting firms in that field right now, in your opinion?
Yeah, across the board. I mean, one of the attractions of our approach is we are very excited about the oil services industry because we think we're very early in that new capex cycle in the oil sector. So one of the largest positions in the fund is Halliburton, a North American focused global leader in the oil services industry. Another top position in the fund is Albemarle, which is a specialty chemicals company in North America that provides supplies lithium into the electric vehicle industry. And to bring some colour around this supernormal demand, if you think about a mobile phone and the amount of lithium that's needed to go into a mobile phone, if you extrapolate that to a car battery, there's roughly 9,000 times the amount of lithium needed to go into a car battery than is needed to go into a mobile phone. And if you think about car companies such as Tesla, and they've recently announced their Model 3 and 400,000 pre-orders in a month for the Model 3, 400,000 times 9,000, we're talking of billions of units of lithium that have suddenly come into the market with regard to mobile phone usage. That is a next stage of demand. So lithium is another position in the portfolio. But similarly, going back to the more traditional resources names, we think that where we are in the mining cycle, there are a number of mining companies that have got new managements, more disciplined capital spending, which means that returns and earnings growth can be driven for some of these mining companies out with the commodity price. But also, we're investing major positions in adhesive labels companies such as Avery Dennison, another North American company, which again has a return profile in excess of 20%, double-digit earnings growth, driven by pricing power, innovation, share buybacks that will lead to ongoing re-ratings. So we've got a really varied portfolio across the more commodity areas, the more downstream consumer type companies, plus at least close to 20% in this next generation of resources. So we're pretty excited about the outlook. Importantly, it's not driven by our view of the next 5 days of the oil price. It's driven by 5-year structural growth that is being underappreciated and undervalued by the market.
Mr. Goodwin, thank you very much.
Thank you.